Good afternoon and good morning, everybody, and welcome to CapstoneLaw's Pan-European Private Funds Lawyers Roundtable. My name is Hans Moritz. I'm a partner with CapstoneLaw Zurich, and I have the pleasure and privilege to be the moderator of today's panel. Times are more uncertain than they have ever been before in the last couple of years. Across the global private market landscape, particularly in PE infrastructure and real estate, deal volumes have plunged as well, as we are all still facing the corona impact across multiple geographies. However, things may turn faster than some anticipate, as many market participants remain optimistic. Capital raising is expected to significantly increase in the second half of 2020 due to a number of mega funds that are still working through their allocation targets, and smaller managers are catching up fairly quickly. Over the next 40 to 50 minutes, we will discuss with industry experts trends on fund formation and distribution, including trends on investment terms in light of COVID and certain country-specific developments. Our amazing panel today is composed of Eamon Devlin. He's a partner with MJ Hudson London and Zurich. Eamon is a corporate and investment funds lawyer with experience in primary, secondary, and co-investments. He's representing GPs and LPs of different sizes and different jurisdictions. He represents a number of GP family offices, fund of funds, and other large organizations. Welcome to the panel, Eamon.
Thank you.
From Frankfurt, we have Benedict Weiser. He's a partner with Simmons & Simmons. Benedict advises on basically all aspects of asset management, regulated and unregulated funds, private equity, M&A, and corporate law. Benedict is particularly experienced in supporting and helping investment of German insurance companies and institutional investors in private market investments. He has an in-depth knowledge of structuring and implementing fund-of-fund and multiple tier structures, fund platforms for indirect investments and tax-efficient structured products. Thank you very much, Benedict, for joining the panel.
Thank you very much for having me.
From Luxembourg, we have Yves Lacroix. He's a partner with Arend and Medernach. And Yves is a partner in the private equity and real estate practice of Arend and Medernach. He's advising financial institutions and asset managers on the organization of investment structures and the Luxembourg operations, as well as institutional investors on the implementation of their investment programs and activities with specific focus on PE and real estate. Thank you very much for joining the panel, Yves.
Thanks for having me.
From CapstoneLaw, we have Dirk Spiegel. Dirk is a partner of CapstoneLaw with over 20 years of legal and compliance experience in the asset management, mutual fund, and private market investments. He advises international and domestic managers, funds, institutional and private investors, banks, and other financial intermediaries on key legal, strategic, compliance as transactional issues. Dirk, thank you very much for joining the panel.
Thank you very much, Hans.
Last but definitely not the least, Andrew Keys. He's a partner with Maples Group in Cayman Island. Andrew is a partner in the investment management team based in the Cayman Island. He works with a broad range of prominent institutional and startup private equity and venture capital houses. He basically advises on all aspects of investment funds work, as well as general corporate and commercial matters. Let's go and let's kick off with our discussion, and let's kick off with Eamon. Eamon, I mean, you're close to a number of European and international PE and venture GPs and a number of fairly prominent LPs. What has been your observation in terms of fundraising activities over the last couple of months with regards to PE and venture?
Thanks, Hans. On fundraising for PE and venture, if I can take venture first. So our experience has been that venture funds raising has been impacted, but not significantly. And the reason for that is, as I'm sure everyone knows in this call, there's quite a lot of effectively state aid available for venture funds, be it in the guise of European Investment Fund for European-based funds or British Business Bank for UK-based venture funds. So venture fundraising has definitely slowed, but not been diabolical. The private equity side, at least from our little data set, has been much more diverse in terms of answer. So for many of our GP clients, they decided to delay their fundraising. So I personally have had my sort of quietest 6 months in my nearly 20 years of working. The two asset classes which have seemed to buck the trend, at least according to our information, is secondaries and infrastructure, people raising money, particularly for renewable energy. But all other sort of asset classes seem to be struggling, at least for the non-mega buyout funds.
Okay. And I mean, with regards to the different sectors and the different asset classes, I mean, have you seen, I mean, from what you're describing, it seems that your experience was to a certain extent diverse in terms of the underlying asset classes and potential investment opportunities which have been in the pipeline of the various underlying GPs. I mean, have you seen any material changes on the terms, on the legal terms, on the commercial terms compared to prior years, or has that remained unchanged?
Because the data set's been so small,
or is it basically too early to come up with a precise answer on that one?
I think you need more information to give a fuller answer, but there are some, I think there are a couple of things if you want me to reflect on sort of changing terms. One is increased demand from LPs looking for co-investment, at least in the sort of private equity field. So LPs finding a way to lower the fee load for their private equity fund investments. And then, not music to GPs' ears, but a continued decreasing pressure on management fees, particularly for funds above 500 million. So but although that trend, to be frank, was well before lockdown, I think. And then lastly, some discussion, I wouldn't say change, some discussion on hurdle levels for buyout funds. So those are probably the few, but yeah, hard to give a complete picture, Hans. It's too early really into the crisis, I would argue.
Okay, have you seen any changes with regards to the communication between GPs and LPs over the last couple of, let's say, 6 months?
We obviously don't see all the communication between GPs and LPs, but from what I hear from both sides of the party, the GPs and LPs, communications seem to have increased. I know that some LPs were annoyed during the last financial crisis that they were kept in the dark. GPs have seemed to learn a lesson that they give better information this time round. There's been some quite fruity discussions between LPs and GPs. The two sets of stakeholders haven't always agreed how to deal with the crisis. So I've seen probably more litigation in the last 6 months than I have done in the previous 5 years. So there has been some debate, discussion, annoyance on how GPs deal with portfolios. So but some communication has been very.
I think there are some difficulties with your micro.
Is that better? Is it any difference?
Yeah, I think you're back now.
So yeah, just on communications, and more communication, but some of the communication has been badly tempered, I would say, between GPs and LPs.
Okay, I mean, you were mentioning litigation. I mean, what were the specific? I mean, obviously you can't go into any details, but what have been the most prominent kind of issues when it comes to litigation in private funds or PE?
Two areas, at least what I've seen, on the secondary side. So buyers agreeing to buy assets at a certain price, and then the crisis hit, and then realizing that the price they've agreed to buy may not be the quote unquote the correct market price. That's been a source of some time and effort. And then the other one is some disputes around how some LPs looking to transfer their interest in Fund X to a third party, and the GP being, to be frank, difficult in giving his or her consent to the transfer. So that has created some legal issues.
Okay. I mean, with regards to transfer rights, I mean, what you see, I mean, you always have these discussions around the GP consent and what are under which conditions the GP should basically provide consent. Do you see, I mean, given all the slowing down of investment pace, and maybe certain LPs are becoming more kind of, let's say, not nervous, but trying to get more protection. Do you see any trend with regards to GPs being more LP friendly in general when it comes to the negotiation of transfer rights?
It depends where the GP is in the sort of power dynamic, I think, Hans. I think if you're a GP that can, raise money at the click of a finger, then the answer is no. But if you're, frankly, most GPs, they have to beg, borrow, and steal to raise money. Is a real kind of, in this climate, to raise a fund. Just on that, the dynamic which is becoming more frequent more common is some GPs will not allow an LP to transfer their interest unless that the new buyer agrees to commit to that fund manager's next fund. So, which is, for everyone's benefit, it's basically a stapling effect. So ex-GP agrees, yes, you can transfer your LP interest to this buyer as long as the buyer agrees to invest in that manager's next fund. So that has created some long conversations.
Yeah, and I mean, ultimately, it still remains kind of a commercial agreement between the GP and the LP, which is always subject to negotiations, and ultimately the buying power of the LP, ultimately, or the GP, right? I mean, even maybe. I mean, you have been a member of the OPA Model LPA task force, which we believe is a fairly important initiative. Could you give us a little bit of background of the purpose of that task force and the major achievements?
I can deal with the major achievements very quickly. I'm not sure there has been many. I think on the I think that the rationale is to make it more effective. So certainly all of my fellow panelists will know this, but forming an investment fund is not the most straightforward of legal dynamics. And to give you some sort of framing for costs, if you're raising a $5 billion New York controlled buyout fund, the formation costs are anything from $10 to $12 million. And of course, the formation costs are paid for by the LPs. So the investors pay for the formation, for the setup costs of a new fund. So that, to the ILPA, the industry body is trying to make the process more straightforward. And one of the ideas was to have a sort of standardized LPA. And there's been two versions now, a kind of what's called a deal fund as a whole LPA, and then more recently a deal by deal LPA, which I think, to be honest, probably an achievement to get 50 odd lawyers to agree on a piece of paper. But the uptake by the industry has been very slow, which may be unsurprising given that many people's interest is not in their interest to have a standardized LPA. But I think overall it's a move in the right direction to have at least a starting point for a discussion on what an LPA looks like for a private equity fund.
Thank you very much, Ivan, for all your insights. Maybe Yves, I mean, from a Luxembourg perspective, I mean, Luxembourg is by far the largest fund hub outside of the US. I mean, would you agree with basically or do you have the same observations regarding the fundraising activities which has been described by Iman, or do you have a different, from a Luxembourgish perspective, do you have a different optic? Yves, I think you are still on mute.
Sorry, is it better like this? Yes, I assume. No, I can only add a little bit to what Eamon has been saying and confirming all points mentioned by all means. I think we can, in addition to what Eamon said, we see deferral of first closings. So it's not necessarily the fundraising. Fundraising has been done. The amounts, the checks are in, but for different reasons linked to COVID, then the first close is not going forward. So, and no, I confirm infrastructure and venture. There is a few initiatives, projects going on, and the other segments are quite slow in terms of new initiatives, except for the usual suspects that do not have a problem to raise a fund. Yeah.
Okay. I mean, you're also active in the real estate area. I mean, from what we hear and see from a number of real estate providers, was kind of that investment activities have fairly slow over the last couple of months. Is that also something which you see?
Yes, I can. Yeah, yes, I can confirm that. We had a few initiatives in the debt segment and also equity for real estate that were sort of initiated in May, June until around early July, and then these projects, or some of them at least, have been put on hold just for the players to wait about what would come. We had a few discussions about some AEV formation for US players willing to go into Europe at the time, but then this was also put on hold.
Okay. Yves, maybe on the structuring options, which is basically provided by Luxembourg as a fund hub, right? So I think it's fair to say that Luxembourg, at least from a European perspective, is people like Luxembourg as a fund hub. When it comes to structuring closed-ended, let's say, private equity and venture capital funds, I mean, could you give us kind of a rough update on the various structuring opportunities which are provided by Luxembourg? So if you could give us a closer look at the toolbox which is provided by the Luxembourgish framework.
Yeah. I'll try not to be too long, and I will not go back to the dinosaurs.
I will stop you in 3 minutes.
Yes. Well, I would say, and all of you know that historically or before the implementation of AFMD, Luxembourg for private fund formation was mainly using regulated fund structures, and with the implementation of AFMD in 2013, Luxembourg took the initiative to basically, renovate some partnership regime that we already had in the company law, but we basically created two types of partnerships: the common limited partnership and the special limited partnership, trying to add to the toolbox flexible instruments to be able to replicate structures that were widely set up in the Anglo-Saxon world. So that was 2013.
Maybe one question. So what were the most important improvements of the partnership law in Luxembourg?
I think basically back then in 2013, the big innovation was the possibility to structure non-regulated funds with all the operating flexibility, connecting it to AFMD if the fund initiator wanted to do it. But really, in the past, basically, you had, to form a private equity fund or a real estate fund, you had mainly the choice between the CCAR and the SIF. And after that, you could create such structures with a limited partnership. And then I think that was in 2013. Now, partnerships, Luxembourg partnerships, are there by thousands. They're being very widely used by fund sponsors to create or to implement their investment programs and raise funds. Mainly for pan-European funds, but not only. And I think one of the, and then there was a bit of a piece missing in the toolbox. That's the RIFE that was created in 2016. And without, again, going too much into details, the RIFE allowed the creation of limited partnerships as umbrella, having the possibility to create sub-funds or compartments for a partnership. It's not always useful. It was a nice to have. I think the big add-on to the toolbox then in 2016 was the possibility to organize a corporate partnership. I share an SCA, so it's a corporate partnership. It's a company that looks a little bit like a partnership, but that really works like an investment company. And with these three new types of structure, the two, I'd say, partnerships plus the corporate partnership that is actually an investment company, we could then in Luxembourg structure a fund as a transparent entity partnership, or as a non-transparent opaque investment company without having the need to seek a prior regulatory approval from the Luxembourg regulatory authorities, which of course takes a little bit of time. So in terms of time to market, we adapted and went in the direction of the more pragmatic, flexible approach of the Anglo-Saxon world.
Do you have any numbers for us? I mean, how many RIFEs are currently in place, and how many assets are being?
No, I don't have that readily available here, Hans. I'm sorry. I can only say that if my remembering is correct, for the partnerships during the first year, the first 18 months, there were more than 600 partnerships created. I think it was within the first year of the creation of the partnership regime. And now I think the RIFE is by far the preferred type of structure for the asset managers, because it's really quick in terms of, much quicker in terms of timing. And then if there is some constraints from the investor side to have a regulated fund, it can be easily converted into a regulated fund, a SIF, for instance. So that's normally the path that is currently being followed, unregulated structure, and then if and when need be, due to investors' constraints or requirements, then it is a regulated structure. There are some exceptions, of course. We both know that.
Okay, and the kind of older Luxembourgish structures, for example, the Partie 2 funds, are they currently still in use, or is that something which is basically not really any longer being used, given that you have the SIF and given that you have the RIFE? What happened to kind of the older funds, and going forward, are these types of structure still in use, or is that kind of legacy?
I think the Part 2 fund, just to explain a little bit what it is a domestic, it's a Luxembourg regulatory regime, domestic, that is allowing fund sponsors to create structures that are not reserved to any type of specific investors. So it's really open to retail investors also. There is no investors eligibility requirement. it was very, very quiet for many years. This was really not in use until actually quite recently, when people started to look at the Part 2 funds again in the context of the structuring of LTIFs, because there you have a specific passporting regime that allows you in certain conditions to touch not only professional investors. So there, the sort of the absence of investors' eligibility constraint brought a new light to this Part 2 type of structure, but it's really not commonly used, well, at least not in what I see in the sort of tangible assets investment space.
I mean, you just touched upon the AFMD regulatory framework and the various types of funds which are subject to all these regulations. I think one thing which actually AFMD tried to improve was the improved marketability of alternative investment funds across Europe, right? And I think one benefit, for example, of a Luxembourg RIF is that the AIF, the manager, basically is in a position to obtain a passport to market that fund across Europe. However, I think after some years of being in place, I think the regulator has seen a number of deficits with regards to EU cross-border distribution. And I think we have seen fairly recently a new directive and a new regulatory framework with regards to cross-border distribution. Do you have any further insights with regards to these activities from an EU perspective? Why is that needed, and what is the key concept of that regulatory piece?
Yeah, I think AFMD is very specific to the extent the passporting or the marketing is well coordinated, organized with this passport that is aiming at supporting the marketing or the fundraising towards professional/institutional investors. Now, in parallel to that, there were other regimes that developed, the LTIF regime, the UVK regime, where these types of funds are not, well, in terms of getting access to the passport and fundraising, it's not restricted to professional or institutional investors. So that was something that is to be improved under AFMD. Whether or not it will change, we'll see. There is at the moment some consultation about the review of AFMD. What we are talking about today is and without going too much into details, is about a directive that was passed last year on the 20th of June 2019, amending, amongst other directives, AFMD to, well, basically with the aim of harmonizing the pre-marketing and clarifying a little bit also who should be doing what in this pre-marketing and also marketing exercise. I think if I don't want to bore everyone very quickly, I would just want to
I think that pre-marketing is a fairly important point.
yeah, but it's a bit technical and sometimes a little bit burdensome to I think the main takeaway should be that there is a key date, that is the 2nd of August next year, so 2021. By then, the EU member states will have to have implemented the directive and make it applicable. I think it will be, in certain cases, a game changer, because there's a certain number of changes contemplated under this directive, and there are gray areas that are quite significant. This directive when it comes to alternative funds, is targeting the regulated, the authorized alternative investment fund managers. And basically, the idea is to have an harmonized definition of pre-marketing, so that regulated alternative investment fund managers will have to notify their pre-marketing activities. There is a definition about what pre-marketing means, so that basically it will be allowed to do that in all EU member states or EEA member states, but with some control or supervision of the relevant regulatory authorities. And then this will be a bit of a limitation to the use of reverse solicitation concept. There is a standstill 18 months period, and the directive states that if basically you've been doing some pre-marketing to investors, then these investors cannot be onboarded with reverse solicitation within a period of 18 months following the pre-marketing. I'm not sure I should go through the definition of pre-marketing. Another point important to mention is that we have a few discussions at the moment about, that the AFM license, the license of an alternative investment manager, is restricted in a way that the management company cannot do things that are not foreseen under the permitted activities for an AFM. And at the moment, there is a discussion about, is it possible for such management company, an AFM, that is not a supermanco, so the one that does not have the UCITS license, is it possible for such an AFM to do the marketing of a fund that it is not actually managing? And the directive now clarifies that this will be possible. So in terms of organizing the marketing, the fundraising, there is flexibility. But on the other side, there are some restrictions saying that third parties involved in marketing, and there will be discussions about what really marketing is. There is a definition about pre-marketing, but marketing can cover a lot of activities. This, when third parties are involved, it is limited or to some types of professionals of the financial sector, and this is not the way fundraising or marketing is organized. Currently, the placement agents are rarely sort of licensed as MiFID investment firms or the likes. So that will change in these two main respects, I think.
Yeah, I think, Yves, that was very helpful. Bottom line is basically that we see kind of hopefully more clearer concepts with regards to a couple of definitions, in particular with regards to pre-marketing on a cross-border basis. Thank you very much.
Yeah.
Benedict, I mean, you look after a number of fairly large German institutional investors, right, including insurance companies and pensions and the likes. I mean, do you share the observations of Ivan with regards to the fundraising and the fundraising activities and the fundraising pace over the last couple of months? Can you confirm that from an investor perspective?
Yes, of course. What we have seen is that when the COVID-19 crisis started, there was quite a rush by the fund managers to get their funds closed. So the managers were pressing on for the investors to make their investments. And to pick up on what Yves was saying, yes, we hardly see any ZIFs anymore. It's really an SCS or an SCSP, and always in the unregulated RAIF structure. German institutional investors wouldn't be looking for any more regulation than is to be had with the RAIF. And after that rush to a close, there was a bit of a calm, and then it was the investors pushing to make more investments, because of course the asset managing investors, so pension funds, insurance companies, banks, they still need to invest their money, they still need to place their money, and it was more on the managers who were looking to find the investments, and that side was slowing down. So the fundraising was slowing down a little bit. Investors are getting more and more desperate to find good investment opportunities. course, they won't put their money anywhere, but they are looking, yes, actually desperately to find good investments. And they would be looking with a much more open mind than they have been traditionally. So ever since the low interest phase has started, the traditional German investors have started to build up own internal know-how. They were taking on people who would have expertise in private equity and real estate, and they would look into that asset class with a view to have a much more significant allocation than they would have traditionally. Just obviously, in given that there is no more revenue to be had in investing in government bonds or other securities. So that is changing, and the German investors are looking more, based on that, the own capacities that they have created to do more joint ventures, to do more co-investments. I think that is something that Eamon also mentioned, that there's a more interest in co-investments, and I can confirm that. And the whole structures and the underlying activities of what managers are offering, they're getting more into an opportunistic area. So if you look at real estate, that means that the real estate, it's really just value added or opportunistic strategies that are being sold now, and that triggers a lot of regulatory issues. Private debt is picking up. So we see the investors looking at that area very closely. Real estate debt, private equity debt style, so the asset classes start to mingle a little bit. The borders between the asset classes are blurred, and that is maybe a good opportunity. Go ahead, Hans.
What about infrastructure, renewable power, all that kind of stuff?
Infrastructure is
see in Switzerland, right? So in particular on the pension scheme side, we see that we saw a regulatory initiative whereby pension schemes, they now have a separate bucket for infrastructure assets, because it seems to be that there is a trend of at least certain pension schemes to basically allocate more to infrastructure. Is that something which you also see in Germany?
Yes, absolutely. So that's a very good point. It's also infrastructure, obviously the classical infrastructure where you see a steady flow of income that would be very attractive and low risk profile. So high quality infrastructure is interesting, but infrastructure can go all kinds of places. It could be power grids, it can be telecommunication grids, and even the more risky stuff would also fly. But in Germany, from a regulatory point of view, just to give a very short introduction to the regulatory space for pension funds and insurance companies, we would look at so-called Solvency I investors who are subject to the German investment ordinance, and Solvency II investors who are subject to the fairly new Solvency II regulations. So they would be subject to solvency capital requirements. That's a quantitative risk approach, and the investment ordinance is a very formal approach. It's crafted with three different parts. It will have one part that says all investments have to be safe, profitable, and liquid. That has a lot of implications, say, as Ewan was mentioning, on free transferability. So I was very interested to hear that the general partners are making the consent right, using that as a leverage on investors, because that's something that German institutional investors will also be cautious, always be cautious about. So first general part, safe, profitable, and liquid. Second, a list of eligible assets, and that's the assets buckets that you probably mentioned, Hans, for Switzerland. So it's 25% for real estate, 35% for equity securities that are listed, 15% for private equity, and 7.5% for alternatives, 7.5% for asset-backed securities. And that is the third part, that the regulation imposes diversification requirements. And if we look at the regulatory really tight asset class, that's real estate. Trying to squeeze operative real estate into the real estate bucket is what we find fairly difficult.
With regards to the underlying assets and asset classes, I mean, is ESG, is that something which is an important topic for German institutional investors?
Yes, it is. And
is it just a buzzword, and when it comes to the actual due diligence of the fund documents, it's being taken into consideration, but if you don't get the relevant hard-coded restrictions, or if you don't get the reporting transparency rights, you still do the investment, or what is the trend there?
So ESG would always be a topic. Nobody can afford not to address ESG issues in any way. But the way you put your question, you're already suspecting that what materiality lies behind that is very different. So what we don't have is, I think, investors who are actually willing to forego any profit with view to ESG considerations. So ESG is an element of risk monitoring. That's also the regulatory approach in Germany. ESG considerations should be a core element of risk management for all asset managers, portfolio managers, and also for investors. ESG comes into play for the Solvency II investors, or it will come into play because it will be hinged to the taxonomy regulation and Solvency capital requirements at one point. That's at least the draft. So that's a form of state aid, actually. But for the Solvency I investors, it is still essentially a buzzword. We will be seeing them asking for reporting. It is a check-the-box exercise for now, I'm afraid, very much.
Okay. Thank you very much, Benedict, for all your insights and helpful overview of the German market.
Thank you.
Dirk, with regards to Switzerland, right? I mean, we have seen a number of regulatory initiatives going on in Luxembourg, in the Cayman Islands. We will come to that shortly in a minute. In Ireland, with regards to improving the situation for certain institutional investors. I think in Switzerland, we also have an initiative in the pipeline, which is called LQIF, which seems to be fairly comparable to what Yves described with regards to the Luxembourg-based RIFE. Do you have any insights on the LQIF? And by the way, L is not the abbreviation in that context for Luxembourg. It basically means limited qualified investor fund and not Luxembourg with, just to be clear on that one.
Yeah. If I may make a joke, just add CCAF behind and then it will be a great tool.
No, so thank you very much, Hans, and thank you, Yves. No, indeed, Switzerland is trying to catching up. With the limited qualified investor fund, Switzerland is trying to create a Swiss alternative for institutional investors only. And obviously, as mentioned by Hans, the idea is to increase the international competitiveness of the Swiss fund market and to create a level playing field for Swiss collective and domestic funds and foreign funds with a structure which is only for qualified investors, similar to the RIFE. That is correct. Yes. So the limited qualified investor fund can be set up in both forms, as we know, in an open-ended structure, like a SICAF, or an investment company as a closed-ended structure in terms of a limited partnership. So we will see then the same structure as we have seen in other domiciles like Luxembourg. So the most important thing for the limited qualified investor fund indeed is that there is no authorization required for an approval by FINMA. So it will be completely free and can be set up and structured very swiftly and fast without any authority from the financial authorities here in Switzerland. And there are more or less no investment restrictions on the limited qualified investor fund. SIMAFI has seen that for other kind of private market funds in other domiciles. There will be all thinkable assets possible for the limited qualified investor fund. And the only thing which needs to be done is that these kind of investments have to be disclosed in the offering documents as usual, and there will be no kind of risk minimum diversification rules. So it will be a pretty flexible structure for institutional investors in Switzerland. Last but not least, maybe as already mentioned, it is similar to the Luxembourg RIFE, so it will be regulated or indirectly regulated through a fund management company, which then obviously can delegate the investment management to a Swiss-based collective investment manager or investment manager for collective investment schemes, or a foreign investment manager with similar authorization in Europe or in other countries. So we expect, and CapstoneLaw is part of the working group and the expert group at the moment. So we are working still on the first draft of the law. So as you know, or if you have heard and seen the press, the consultation came out a couple of 2 weeks ago, and we're still looking forward and hope that the limited qualified investor fund comes into force by end of 2021. Beginning of 2022.
I mean, what has been the feedback from potential GPs, LPs on the LQIF draft so far?
So what we have heard is very much appreciated. I mean, it is appreciated that Switzerland is trying catching up, with other countries in Europe. It is appreciated that Switzerland is trying to set up a Swiss domiciled alternative or a fund which is very flexible with now authorization. It is appreciated that there is no authorization needed by FINMA. And what we heard from the one or other institutional client, particularly from pension funds, is that they are looking into that vehicle and that they consider to repatriate, their foreign funds to Switzerland if the draft, as it is at today, will stay as flexible as it has been discussed so far.
Thank you. I think repatriation will always be a very tough exercise. I think Yves will basically agree to that. But I think going forward for new entities and for new kind of vehicles, I think that the LQIF might certainly be an option for investors for GPs and investors going into illiquid assets. Thank you very much to our panelists for this very interesting discussion. It was a great pleasure to host this roundtable. Thank you very much, and see you next time.